So welcome to the Property Cloud TV. For those that haven't been here before, I'm Aaron, I'm the owner of the Property Cloud, and today we're with Ben Quinnell of Nova Mortgages, and he's here to answer a few questions that we typically get asked by home movers, by first-time buyers, sellers, etc., as well as questions that have been put to us by followers on social media. So Ben, do you want to tell us a little bit about you, your background, and your experience?
Yeah, so I'm Ben. So I've been a mortgage broker for the last 12 years. Worked with obviously yourself, I think probably for the last 5 years or so now. I'm pretty much based in the same areas as yourself. So covering mainly SE and DA postcodes, although I can help anyone wherever they are in the country. I've got clients in Scotland, Wales, anywhere you are, we can help. And yeah, we cover sort of residential, first-time buyer, home movers, holiday homes, as well as the buy-to-let market, including limited company buy-to-lets as well.
Okay, fantastic. So it's quite a wide variety of people that you potentially can help there. All right, thanks, Ben. So I'll start with probably the first question that is maybe quite obvious to some, but just in case there's others out there that don't know what it is. Can you explain what a mortgage is and why it's essential for most home buyers?
Yeah, so a mortgage, essentially, in really, really simple terms, a lot of people overcomplicate it. It is just a big loan that you use to buy a property. The difference between sort of a mortgage and a personal loan that you might use to, I don't know, pay for a holiday or a wedding or something like that, is the mortgage is secured against the property.
Okay.
So ultimately, the banks lend with the security of knowing if you are unable to make payments, eventually they can repossess the property, sell it to recoup their funds. And obviously they're essential because there's not a lot of people out there. Obviously there are a few that we see, but not a lot of people out there can afford to buy a property outright with cash in the bank.
Thank you for explaining that. And I guess it's important when you're talking about repossessions for people to ensure, if they're going to apply for a mortgage, that they have the capability to afford the repayments moving forward.
Yeah, definitely. And of course, again, not so much something that we'll cover in this video, but is obviously when we set up a mortgage for someone, we'd offer them a whole range of insurances to make sure any eventuality, they're protected, they're covered, so that they don't lose their home ultimately.
Fantastic. Okay, cheers, mate. I appreciate that. And so moving sort of from there then, for a lot of home buyers, whether they're first-time buyers or just typical, if they're selling and moving on, how much of a deposit is typically required for a mortgage in the UK?
So the vast majority of lenders will ask for a 5% deposit, which I think most people are aware of these days. What some people might not be aware of, there is one lender out there at the moment that is offering a 5k deposit mortgage. So for properties up to 500,000, it does need to be a house rather than a flat and not a new build. You can put down a deposit of just £5,000. So say if you're buying at 500, that is just a 1% deposit that is needed.
Yeah, that's pretty good.
So yeah, it's designed to help people, someone who can't build a big deposit, get onto the property ladder. You do, of course, you do need to have the earnings and be able to prove you can afford the rest of the mortgage. But yeah, as a pure deposit, you need is the £5,000. Okay. So that's a really good option. And even lower than that, there are a couple of lenders out there with schemes that offer mortgages with no deposit at all. So there's one that is offered to people that are in rented. So people that are paying, say, obviously large amounts of their income in rent each month. Again, just prevents people from saving those deposits that most lenders need. But that lender will lend 100% of the property value based on that person's track record in renting. So because they can see, and you will have to prove this, of course, that you've had at least 12 months of rental experience, that lender will give you a mortgage. They do the normal affordability checks as well, but secondary to that, they check your affordability based on the rent you're paying at the moment.
This is like a first of its kind, right? This type of mortgage.
Yes, certainly the first of its kind since sort of 2008 and the crisis. A lot of the low loan to value mortgages were pulled from the market when we had obviously the pandemic. The government stepped in and the government backed a lot of the 5% deposit mortgages that most lenders offer. But obviously this goes one step further than that. Yeah, it's really, as I say, for the right, it's not going to help everyone.
No,
as I say, first-time buyers living at home, it's not applicable. It is for those in rented, but those are the ones that we see a lot of the time can't build those deposits. So it's a great product for those clients.
Definitely, particularly I think where the rents have gone up so much over the last few years as well.
Exactly, and as I say, and they use, as I say, a common sense approach. They're saying if you can afford, because essentially what they do is they make sure your mortgage payment is no more than your current rent.
Right. Okay.
So they say if you've been paying £1,600 a month for the last year, you can afford a £1,600 a month mortgage. So yeah, as I say, so there are schemes out there even below the traditional 5% deposit, let's say, which most people know about.
Yeah, fab. Okay, mate. And can you explain what a loan to value or LTV ratios are, and how they impact mortgage options as well?
Yeah, of course. So the loan to value is the loan as a percentage of the property value. As we said earlier, the loan is secured against the property.
Yep.
So the higher the loan to value, the more loan you have against that property, the higher the risk to the bank. To protect themselves, the higher the loan to value, it does obviously cause changes. Mm-hmm. The main one that a lot of people will know about is the higher your loan to value. So a 5% deposit would be a 95% loan to value.
Yeah.
That is where you're going to attract the highest interest rates.
Right. Okay.
Okay. So often we'll see it. Someone's buying a property for, I get this quite often, buying a property at 310. Yeah. They say, I've got a £30,000 deposit. I'll always sort of stretch and ask the question and say, could you make that 31,000? Because if you put down that 30,000 on a 310 value property and you're putting down 9.9%, you're going to get offered the 5% deposit interest rates.
Yeah.
So if you can find an extra £1,000, your interest rate on the whole loan comes down. It can save you a lot of money. So that's the first thing. And they tend to move in 5% bands. So 5% deposit at 95% loan to value, 90% loan to value, 85% loan to value. And at each bracket, your interest rate will get better and better.
Yeah, lovely.
Yeah, not only that, most lenders also will change the amount they'll lend to you based on your deposit.
Okay.
So a lot of lenders with a 5% deposit will lend less to the same clients with the same income to the identical clients with a 15% deposit. And it can be as much as sort of their annual income. So if you've got a couple on a joint income of 70,000, the same bank would lend 70,000 more to the people with 15% rather than the people with 5% deposit.
Yeah, and that's all about risk calculations, right?
Exactly. Yeah, it's to do with the risk, the chances of them getting their money back.
Yeah.
And also, let's say they know the people with the 15% deposit that the interest rate is going to be lower, so you can afford to borrow that little bit more.
Yeah.
Another way it affects things, which I don't think a lot of people realise, is the credit score requirements. So most lenders, to get a 5% deposit, you need to have a really squeaky clean credit report. It's a very, very minimal, if any, missed payments. As your deposit goes up, the banks become more flexible. We see this quite often. We'll tell you, if you applied for a 95% mortgage, they might say, sorry, we can't help with a 95%, but we'd be happy to offer you a 90% mortgage.
Got ya.
So yeah, that's something, again, that loan to value affects that not a lot of people realise.
So how can people improve their credit score, Ben? What can they do?
With the credit score, there's not many quick fixes out there, in all honesty. So it's something that needs to be built months, if not years, in advance of applying for the mortgage, because they'll look at your 6 years worth of history for your credit file. Okay. So it's not something that can be quick fixes. If you're not on the voters register, apply to go on that. That can give you an instant boost. And also, not a common mistake we see with credit scores is people taking out credit to sort of build their credit file just before they apply for a mortgage. Like I say, if you do that 2 years ahead of time, you get a credit card and you sort of use it and pay it off, and you show over a time period you're using it responsibly, great. That can help. If you apply for a credit card and the next month apply for a mortgage, that lender's got no idea why you've just taken out that credit card. Yeah. And they do assume the worst sometimes. Is that person struggling? Is that why they've now had to get a credit card? They don't think, great, this person's sort of, proving what a good borrower they are, because they've not had the time to do it.
That's good to know. It's good information. And I think it's good because I think, as you say, a lot of people probably don't know that. Because I have, I think maybe even I've done it in the past where you've taken out a credit card, sometimes just because they've offered you a good, like a 0%. interest rate, and they
Yeah.
send you a letter and say, oh, you can apply and you can get this much, you can borrow this much, etc. So I think sometimes you do get tempted, but I think it's good, as you say, to know for buyers, if you're looking to buy a property, then perhaps avoid the temptation of
as I say, it's something that's very, very difficult to influence once you're looking for a property. And sadly, if there are historic problems there, sometimes it can take 6 months, 12 months in order to make the changes necessary to then get approved. Best thing to do is, as I say, get in touch. As I say, loads of companies offer free trials to sort of check your credit, and we can sort of guide you through the next steps if that is a concern for anyone.
All right, excellent. Thanks, Ben. Okay, so moving on. So a few more questions to follow from there. So what are the different types of mortgages available in the UK? So what mortgages are available to the sort of common home buyers?
Yeah, so I'll go through the most common ones, because obviously there are loads and loads and loads. And the most common one we see, everyone knows about, is obviously fixed rates. So for the past, as long as I've been doing it, fixed rates are, say, the default option for 95% of borrowers. As I say, some people, I think that they think that is all there is.
Yeah.
And that is essentially a mortgage where it's fixed, so you know what you're paying for a set period of time.
Okay.
And the most common options are 2-year fixes, 3-year and 5-year. So you'd start your mortgage contract with a guarantee of this will be your interest rate and this will be your payment for this period of time. And no matter what happens in the market, in the economy, those payments are guaranteed. At the end of your fixed rate, every lender will also have a standard variable rate, which is generally quite a bit higher than a fixed rate. But at that point, during your fixed rate, you'll have early repayment charges. Okay. So the lender's making a commitment to you that they're not going to increase your interest rate.
Yeah.
You're also making a commitment that you will stay with that lender for the 2 years or 3 years or 5 years. Yeah. If you was to leave to go to a different bank or sell your property and exit the marketplace completely, there would be early repayment charges for that. All right. Okay. Once you get to the end of your fixed rate, you say your fixed rate ends, so you move on to the lender standard variable rate, which, like I say, is generally quite a bit higher. Most of them at the moment are between sort of 7 and 9%, so really, really high. But they don't have any exit fees.
Okay.
So generally, your lender or your mortgage broker will get in contact with you 6 months before the end of your fixed rate. Mm-hmm. Say, look, your deal's coming to an end. Let's start having a look at what's the next step after that fixed rate. The standard variable rate is generally set by the lender, so they can. It doesn't happen very often, but they can increase and decrease that rate at their discretion. And some lenders use it as a marker how much they will lend. So they stress test people at their standard. They say, great, you're getting a fixed rate at 4%, but could you still afford it once you go on to our 8% variable rate?
Right.
And that's one reason we see lenders move that, is to try and, if they want to lend a little bit more to people, they reduce it. If they think they're being overly generous, they might increase it to reduce those numbers. Yeah. The other option, which is becoming more popular in sort of the high interest rate environment we're in at the moment, is a tracker mortgage.
Yeah.
So a tracker mortgage takes out the sort of the lender's ability to move the rate up and down. So it'll be set against a benchmark. Obviously, the most common one, the one we're seeing in the news a lot of time at the moment, is the Bank of England base rate.
Yeah.
So the lender will say, we will offer you a mortgage at the Bank of England base rate plus 1% for 2 years. So if you take a tracker mortgage and the Bank of England base rate goes down 0.25%, your rate goes down 0.25%, and your monthly payment goes down. And as I say, there's obviously wide expectation that rates will come down, hence why they are becoming more and more popular.
Yeah.
Compared to what they were 3-4 years ago, where interest rates were very, very low.
Yeah.
With trackers, again, you've got to be careful. I always would prefer my clients to go onto trackers. Some lenders offer them with no exit fees. So if the market does change rapidly, as we've seen it can do in the last couple of years, you can switch and go onto a fixed rate without seeing out your full 2 years. Other lenders will still have exit fees.
Okay.
So you're on a tracker, and if things don't go the way that you're hoping that they do, it's then going to cost you a big fee, exactly right, to come out of it. And so, that's something to look for. Say, don't just assume all trackers are free to come out of, because they're not. It is lender specific and sort of product specific as well.
Okay, lovely. And that's where someone like you would come in to be able to guide.
Exactly right. Yeah. So
around and navigate.
Yeah. So we would say, look, we've got these 2 trackers. This one's a little bit more expensive, but it gives you the facility to leave free of charge.
Yeah.
And that, say, a lot of people with the trackers and the uncertainty like the option to come away from it if they want to without being charged hefty fees.
Got you.
So yeah, that's where we would come in and say, these are the 2 products. Which one suits you best?
Got you. What about interest only, Ben? Do they still exist, or
interest only does still exist?
Yeah.
They're not so in the residential market. If you're buying your home, they're not as common.
Mm-hmm.
Reason being, the lender ultimately wants you by the time you retire to have paid that mortgage off, so you don't have monthly payments anymore. So for interest only, there are strict rules. Most lenders will have a minimum income. So you'll need to it varies lender to lender, and some lenders don't have a minimum income. Most of them start from, you need to be earning £75,000 a year or more in order to opt for an interest only.
Yeah.
Also, the deposit requirements that we spoke about earlier are a lot higher, because where you're not making payments towards the mortgage, your loan isn't getting smaller. The lender wants to make sure in any eventuality, if property prices were to fall slightly for any reason, there's enough equity there that they're protected as well.
Yeah, got you.
It can be really helpful for some clients. Maybe someone who's looking to downsize in a few years that doesn't need to pay off. Doesn't need to pay off the mortgage. Someone who's got a big pension that's going to be paid in a couple of years that they can draw some funds out of to pay the mortgage off.
Yeah.
But they're not very, very common at all. Because the lender would rather the clients have certainty at the end of the mortgage will be paid off.
Yeah, that makes sense. In actual fact, I actually went to value a home for someone recently, and not to go into too much detail, she was unwell at one point in her life, going back a few years back now, and changed her mortgage to an interest-only mortgage and never changed it back. So they've got a huge outstanding loan, and their mortgage comes up in next year, so they're being forced to sell in order to pay off that mortgage loan. Yeah. I
mean, it's something we see at the moment with, not so much buyers, because they know what they're getting themselves into, but when people whose fixed rates are coming to an end from sort of 2, 3, 5 years ago, obviously their monthly payments are jumping up, and it's something a lot of people are asking about, is interest only. And obviously they sort of say, well, can I do interest only for 2 years? Like you say, it's not, if you do interest only, it is for the full length of the mortgage.
Yeah. And
you then at some point say, if you don't ever switch it back and the onus is on the applicant,
of course,
people can end up in those situations, which is why, as I say, the lenders do put these not hurdles, but they put these steps in place to protect people and make sure only the clients it's right for. Yeah, exactly. Only the clients it's right for can sort of access those interest only mortgages.
Yeah, cool. Okay. And can you explain a little bit about how the interest rates are determined, what factors influence them? Because I know sort of swap rates have come down recently, so maybe talk a bit about that.
Yeah. So interest rates. So it's obviously the sort of the trackers I spoke about. As I say, they are linked directly to that Bank of England base rate. Yeah. So if the Bank of England base rate goes down, your tracker rate comes down alongside it. So really, really simple to understand. The lender will offer you Bank of England base rate plus 1%, and that's it. Fixed rates are a little bit more complicated, and I think potentially where we have seen a little bit of a slowdown in the market recently is because of this. A lot of people also think the base rate has the same relevance on fixed rates. So I get a lot of people say, I'm waiting until August, for example. So there's a Bank of England base rate meeting next week, because they might cut the rates. And they assume if they cut the rates, all the fixed rates are going to come down by the same 0.25%.
Yeah.
Fixed rates are priced differently. So they're priced based on what you mentioned earlier, the swap rates. And the swap rates essentially is how the lenders back and fund their fixed rate mortgages.
Yeah.
So yesterday, I had a look. So a 2-year swap rate for a lender. So what it cost a lender to get that 2-year money was at 4.3%.
Yeah.
So obviously that is below the Bank of England base rate, which is 5.25% at the moment.
Yeah.
And essentially the reason it's cheaper than the Bank of England base rate is because a 2-year fixed rate, for example, is based on predictions over the next 2 years.
Yeah.
So if a fixed rate is lower than the base rate, it's an indication that banks feel the rates are going to come down. Yeah, exactly.
Got you. Yeah.
But like I say, the actual interest rate cuts that we'll see from the Bank of England are already factored into that.
Yeah.
So if they do, fingers crossed they do cut the rates on the 1st of August, yes, all the tracker rates, they'll definitely come down 0.25%. Fixed rates already been accounted for. So we won't see any dramatic fixed rate reductions.
No. Okay.
And yeah, and again, 5 years, again, we're seeing at the moment 5-year fixed rates being cheaper than 2 years. Again, it's because over the 5-year periods, the predictions are the base rate will be lower.
Yeah, got you. Okay. So actually, because we've already started to see the swap rates coming down, and we've started to see mortgage rates coming down slightly, it doesn't make sense necessarily for someone to hold fire and wait for the base rate to change. If they were...
Definitely not. So for a couple of reasons, as I say, one, the base rate cuts have already been taken into account.
Yeah.
Two, as I say, with my existing customers, as I say, we get in contact with them 6 months early. But this is also applicable for a buyer who, if you applied for your mortgage today on a house that you had an offer accepted on, that mortgage isn't going to start 3-4 months' time.
Yeah.
In the period between when you apply for your mortgage and, for example, a first-time buyer, when they pick up the keys to their home, if the interest rates in that time go down, your broker with the majority of lenders can keep changing that rate for you. So your rate gets lower and lower and lower, and it's only set in stone at the end of the process. Wow. So you will benefit from the future interest rate cuts in those months. Yeah, in that time frame.
Yeah.
Another reason is that you say with sort of property prices, as the interest rates come down, the property prices tend to do the opposite. So you could end up waiting for rates to come down and then ended up paying more 10, 20,000. Yeah, exactly right, for the same property. So yeah, it's not something, especially with first-time buyers, it's not something that I advise that you try and time the market. It's just when you've got your deposit, when it's the right time for you to move, we'll always sort of make the best of it.
Yeah, I agree with that. Okay, lovely. And sort of moving on from there, the next question that I've been sent. So what specific mortgage products or schemes are available for first-time buyers in the UK?
So there's not been, since Help to Buy ended, which was obviously on the new build where you got the equity loan from the government, there's not really been a similar scheme of that size come in. We've obviously got a temporary, first-time buyers have got a temporary stamp duty break. So if you're a first-time buyer, at the moment, you don't pay stamp duty on any properties up to 425,000.
Okay.
However, the new government have announced they're not going to extend that beyond the 31st of March next year.
Yeah.
So from 31st of March next year, you'd only not pay stamp duty as a first-time buyer on properties up to 300,000.
Yeah.
So that is a holiday rather than a permanent change.
Fixture, yeah. So in an ideal world, then, if you're a first-time buyer, you want to be trying to capitalise on not paying stamp duty up to 425 before the end of March 25.
Yeah, just going back to what we said earlier, as I say, it's just, as I say, that the interest rate shouldn't be the sole. As I say, if you can take advantage of reduced stamp duty, that will make up for potentially a slightly higher interest rate.
Yeah.
Apart from that, you've got the lifetime ISAs, where, say, if you use that money to save for a property, you can use the government bonuses, so that can really help people boost their deposits. And most, say, I'm sure if you have a look online, you'll be able to find most lenders will, or most banks will provide those lifetime ISAs.
Yeah,
so that's something everyone should have a look at. And there are also not so much sort of schemes, but lenders are aware how hard it is for first-time buyers to get on the property market. So just a couple of examples. Nationwide, they have a particular scheme for first-time buyers where they will lend them 5.5 times their income, which is, say, quite rare. And normally to get that sort of level of borrowing, you need to be in the, say, higher earners, sort of 100K plus.
Yeah.
With Nationwide, for a sole person to qualify, there are affordability checks. So it depends on your outgoings. But to get 5.5 times income, it starts from people that are single people earning 30,000.
Yeah.
So that can really, really boost someone's budget, help them get into the area they want or the size property that they want. TSB are another one. When they're checking how much they can lend to people, their stress test, so the rate they use to check, can you still afford this mortgage if rates go to X, is lower for first-time buyers than what it is for home movers. Again, so they can lend first-time buyers more, help them get on the property market. But yeah, fingers crossed they do bring out some schemes. Obviously, Help to Buy was extremely popular.
Yeah, I know there's calls. I read the other day there's calls for it to come back. So I have to watch this space, I guess.
Yeah, definitely.
The current government. Okay. So while we're on the subject of first-time buyers, then perhaps you can walk us through the typical mortgage application process from to give first-time buyers or any home buyers are maybe not familiar with it, just an idea on what to expect.
Yeah, so either before you start looking for a property or whilst you're out shopping for a property, the first thing you can do is get a decision in principle. So that is that's when the lenders do their soft credit check. So they will credit check you and say, based on your credit search, yes, we can give you a mortgage, or no, sorry, we can't give you a mortgage.
Yeah.
And at that point, they'll also tell you how much they're likely to lend you.
Yeah.
Now, at that decision in principle stage, the lenders don't ask for any of your documents, pay slips, bank statements, things like that. So they're relying, if you're speaking to them directly, they're relying on you knowing exactly what they want to hear. And if you go for a broker, again, they're relying on the broker giving accurate information.
Yeah.
And that's why it's a decision in principle rather than something more formal, because at that stage, they're not double checking what you're telling them. So obviously, I'm sure you've seen it before. Someone gives you a decision in principle for 400,000. 3 weeks later, after they've secured the property, actually, you can't borrow that anymore because we've checked your documents and it wasn't quite right.
Take them out a loan.
Yeah, exactly right. Yeah. So, or even just, as I say, even just not putting in. So common things that I see with people that are speaking to the lender directly is if they get overtime. So depending on the lender, some lenders might want to know your last 3 months. Some lenders want to know your last 12 months. Some lenders want to know your last 2 years. So based on those figures, you might put the wrong amount in to tell the lender. If you put in your last year's figure, they might go, we want the last 2 years, and it might be less. So then they'll lend you less when it comes to those checks.
Got you.
So that's the first thing you can do is that decision in principle. And really, that's the only thing we can do up until the point you make an offer on the property and that offer gets accepted.
Yeah, and from an estate agent's perspective, just for viewers, we want to see that you've got a mortgage agreement in principle because we want to see that you've had those initial checks and that you are serious as a buyer. So if you are making offers, your offer should be accompanied by your mortgage agreement in principle plus some other documents, which I've covered on another video. But yeah, sorry to interject, Ben, but I just thought I'd add that in.
No, of course.
Just in case.
Yeah, and that's the reason we do the decision in principle is because we know, as I say, either when the clients are viewing or when they make an offer, the estate agent is going to ask for that for proof that they can back up that offer. And then, as I say, the next stage is once they get the call saying, yep, your offer's been accepted, congratulations, then we can go ahead with the full mortgage application.
Lovely.
So this is where we sort of reconfirm what we've told the lender at the decision principle stage. And we also package your application. So we would send up at this point documents to the bank. So we'd send them some documents we generally ask for: identification for yourself, so the bank knows who you are, 3 months pay slips, generally, say that can vary depending on your circumstances, and 3 months bank statements to see what your outgoings are as well as your income. And finally, proof of deposit. Make sure you've got the funds to buy the subject property. And again, they also want to check where those funds have come from.
Fantastic.
So we send up all of those documents. Generally, it will then go to an underwriter at the bank. So that is the person that will check on the application. You told us you earn £30,000 a year. Your pay slips, that matches. You do earn £30,000 a year.
Yeah.
Again, they'll go through the bank statements. Again, they'll compare that with the credit search they've done, as well as what you've told them about your outgoings. Make sure all of that is up to scratch. And as I say, they'll ask some questions about the origin of the deposit. So if it's a gift, they'll want to know who is gifting that money, where that person got the money from. Say just to make sure they're keeping up to date with their anti-money laundering checks. Yeah,
of course. Yeah. And how long does that sort of typical process take, Ben? So from the point of mortgage application going in, once you've had an offer accepted, on property, up to the point that your formal mortgage offer is granted and that bank have basically said we will lend you this money against this property?
Yes, it can vary. So we've seen them where the offer comes out immediately. So the banks, so the final step in the process after the underwriting is the valuation. So that's where the bank visits the property and make sure you're paying a fair price and you're not overpaying for the property. Because again, that affects, going back to the start, affects their security. They want to know, say, they're going to get their money back if anything was, for any reason you can't pay. Now that valuation, I say, this came very prevalent during COVID. The lenders try to value properties as much as they can without setting a foot in the door.
Yeah.
And a lot of the time now they use data from Rightmove, Zoopla, Land Registry. And a lot of the time the bank's own systems, it's not human. The bank system will value the property. And obviously that is instant. Again, checking your income. A lot of banks have a feed in from either Experian or HMRC. And they will, again, try and verify your income without wanting to see your documents.
Right. And
if they can do both of those things, they can offer the mortgage instantly.
Yeah.
But generally, as I say, I'd say up to 3 weeks.
Yeah.
I say that's where we have to go through the full process. We have a couple of questions come back once we've sent up your documents.
Yeah.
The valuer perhaps can't get into the property for a week or so due to their own diary being quite busy. But yeah, after 3 weeks, generally we'll have your full mortgage offer.
Yeah.
But say it can vary, say either side.
Yeah. And obviously a lot residential mortgages, buy-to-let mortgages on the flip side, obviously they can take a bit longer, particularly where limited company purchases are involved, etc. as well. So we experience that quite often with that type of mortgage.
Yeah, there's, as I say, depending on the mortgage, again, if say sort of more specialist lending, maybe someone perhaps with some adverse credit in their history, the lenders will go through things a bit more thoroughly. So they will have more questions. Why was this payment missed 2 years ago? What was the circumstances around that? Making sure that type of thing doesn't happen again. But yeah, say the more complicated it is, the longer it will take. But again, we'd always set expectations and let you know what's going on and how long it's likely to take.
Sounds good. And then moving on to, I'm going to roll these two questions into one. What are some common mistakes that home buyers make during the mortgage process? And how can these mistakes be avoided typically?
Again, I wouldn't say there's many mistakes. There can be things that we see that say the big one, which I think everyone's quite familiar is excessive gambling. And when we say excessive gambling, I've had clients say they've stopped sort of betting, even doing their £10 accumulator at the weekend. That's not what the lender's looking for. It's when it is, say, hundreds, if not thousands of pounds a month.
Yeah.
And say is essentially an addiction rather than something you do as a hobby once a week.
Yeah.
The other thing that we see, again, I think it's a lot of people know about it being a pitfall now, so we don't see it as often as we did a few years ago, is when you're transferring money to friends and family, try and make that reference clear as to what it is.
Yeah.
Don't try and be funny. As I say, it doesn't generally cause a mortgage to get declined, but it can cause delays because the bank has to phone me and then I'll have to have your good conversation and ask you, look, you've put this reference. What was that money actually for?
Yeah.
So try and just, as I say, if you're transferring money to someone for part of a holiday, whatever, just label it so the bank, it's very clear to the bank that is what that money is for.
Yeah, sounds good.
Going back to the credit as well earlier that we said, I've seen, again, something we see is people taking out credit just before they do a mortgage application to try and boost their credit score. I'm going for a mortgage, I've not got much credit, I'll go get a credit card just before I get a mortgage application. Yeah. A credit card, if you're using it and then paying it off when you get the bill each month, fantastic. But the lenders like to see a track record of that. Yeah. So they'd like to see for the last 2 years, for example, you've used your credit card, paid it off when you got the statement. If you take a credit card and then apply for a mortgage, the lender is going to think, why is this person who's never needed a credit card now just had to get one? Yeah. Is there a cash flow problem?
They've got a problem. Yeah.
Yeah. They're going to think to the worst case scenario to protect themselves. Yeah. So yeah, things like that. As I say, last minute, there's not much we can do to boost credit scores. So don't try and do something like that to boost it.
No, fab. Okay, man, that's great advice. And then what are the current trends in mortgage interest rates? I know we covered this a little bit earlier, but what are the current trends in mortgage interest rates? Where do you see them heading in the near future, if you can answer that?
Yeah, so we can't really give predictions. As I say, we know things can change very, very quickly.
Yeah.
But in terms of the trends at the moment, say we deal with nearly 100 lenders, and I can say every day for the past 3 weeks or so, a lender has emailed me saying we're cutting our rates tomorrow. We're cutting our rates tomorrow.
Yeah.
And I say it's very much a downwards trend at the moment, which is great news for anyone with a mortgage or looking to get a mortgage. So it does cause us extra work. So like I say, all the mortgages we've done in the past sort of couple of months, we are going back over, double checking, making sure people are on the best rate possible. But yeah, it's a great news for everyone. And yeah, as I hopefully, fingers crossed, it continues for the foreseeable future.
Yeah, no, sounds good. Okay. Home buyers or homeowners, how should they prepare for potential changes in the mortgage market? I think that's quite an important question, particularly as, you know, everything is, you say, starting to change a little bit. And I know that there's been a lot of homeowners that have been putting the brakes on, and home buyers, you know, first-time buyers have been putting the brakes on, waiting for rates to change or waiting for a little bit of stability in the market, particularly since the election was announced, etc. So, yeah, what can you...
as I say, I think we sort of alluded to it earlier. I say, particularly homeowners whose fixed rates are ending, the best thing to do is not to leave it to the last minute. So if your mortgage is ending in December, we can put something in place now. And if those trends do continue and rates go down, we can continually update your interest rate to make sure you get the best rate that is available. If, however, we lock something in now and rates go up, you will get the rate we discussed today, not what it is in December. If you leave it and wait, it is a gamble, because we've been in this position a couple of times over the last 2 years where we thought, great, rates are on the way back down. And then something happens, they start going back up again. I say the start of this year, we started to see interest rates beginning with a 3 again. The market was really, really busy. And then the interest rates didn't get cut when they was expected. So we saw the fixed rates go up again. So it's not, as I say, it's not guaranteed. So the best thing to do is to sort of lock in the mortgage and then review it on an ongoing basis until it kicks in. So same for buyers. Again, if you think, actually, I want to move the end of this year because I think rates are going to be lower in December. If you was to buy a property in the next couple of months, you're likely to move in around that time. And they say we'll get you the best rate between now and December, whether that's in December or whether it's now. We'll make sure you get the best possible interest rate on that.
Fantastic. And are there any sort of online tools or resources that you would recommend for home buyers to better understand their mortgage options, or would you always recommend to speak to a broker? I know the answer to this.
I'd always recommend
watching.
Yes, I'd always recommend speaking to a broker. As I say, I mean, we had a client, obviously someone who was buying a flat through yourself a couple of months ago, who'd spoken to their lender. Lender had told them they can borrow just enough money to buy a 2-bed flat. They say, thought, you know what, we'll speak to a broker just to see if we can get a better rate on that 2-bed flat. So I had a chat with them, and in actual fact, by moving them to another lender, I was able to get them a bit more. Say, unfortunately, I think that did cause one of your sales to fall through, but that client is now buying a 3-bed semi-detached property. And that's going to avoid them in the future upsizing and having estate agency fees, another set of solicitor fees, higher stamp duty. It's really, really important, as I say, to speak to a broker so you are getting all of your options rather than just one of your options.
No, I think
again, even say that you've got the comparison tables online where you can say, this is the mortgage I want, who's the cheapest. That cheapest lender, if you go, right, that's the cheapest lender, they might not be able to lend to you. We will know, actually, the third place one will. Whereas if you go, a lot of people, when they get a knockback from a lender, assume it will be the same with everyone. And that's something we see that's quite common is we can help people that one specific lender just, say, can't help with.
No. So how can they, like these potential home movers, how can they stay informed about changes in the mortgage market?
Yeah, the best. I mean, it's in the news everywhere at the moment. So a lot of people are ringing me and sort of asking me and telling me what they've seen in the news. So it is everywhere at the moment. The other thing to do is say get in contact with a mortgage broker. Say any queries, questions you've got, speak to them because we do deal with this day in, day out.
Yeah,
and say we know. Like to think we all know what we're doing, and as I say, we can sort of give you the best guidance.
Yeah, definitely. And I do think as well, I know again you touched on it earlier, but just to reiterate really that we see often where people go to their bank solely and yes, they get offered a good rate. They've maybe been a customer with that bank for years, so they feel they're getting the best deal. But actually, when that person then goes on to speak to yourself, Ben, typically, or just an independent broker, they are finding better deals available to them. And if it can't be done, then back. But I think it's always worth speaking to an independent mortgage broker to navigate the mortgage market. Make sure you're getting the best deal. Make sure you're getting the best interest rates, the repayments, and actually, if you can, as you say, borrow more to buy something better. Then even better for the potential buyer. So I think that's great advice, mate. Do you have any final tips or advice for home buyers navigating the mortgage process?
No, I think we've covered it all really. As I say, just going back to the point, the bank. The reason people go to the banks generally is because it's who they've got their debit card with.
Yeah,
and that is why you see banks say, open a current account with us, we'll give you £200. Is because they know later on down the line you're going to get a mortgage with them, you're going to get your loan with them. Speak to a broker, shop around, and just make sure you get some advice as well. I say a lot of people sort of doing it online. NatWest in particular, they are offering cheaper deals if you do the mortgage with them and never speak to someone. So you're doing it yourself. And I've got another client at the moment who was dealing with their lender last year. The lender has tied them in for 5 years on a fixed rate, and they now want to move. That lender won't lend them enough. I found the lender that will lend them enough.
They've got to pay a repayment charge.
Yeah, and they've got £8,000 worth of exit fees to pay to that lender now.
Yeah,
because they didn't. Just ask them, what are your plans? Are you looking to move?
Yeah.
They could have gone on to like a tracker rate with no exit fees, or just even a shorter fixed rate. Which would have had a lot lower exit fees. If you know someone's circumstances are about to change. So it's just always important to make sure you're getting advice. Because mistakes can be costly. Yeah,
definitely. God, £8,000 out of nowhere. It's a lot of money to find.
Exactly. It just comes off the budget, doesn't it? It's speak to a broker, even if it's just for some information. Just make sure you're sort of well informed before you it's ultimately it's the biggest purchase you're going to make, isn't it? Buying your house and taking out your mortgage. I don't understand why people wouldn't want to shop around and see what options are available to them.
No, it makes sense. I feel the same, mate, to be fair. Okay, and so if any of the viewers now are coming up to remortgage terms or looking to get onto the property ladder for the first time or looking to sell and buy on, how can they get in touch with you, Ben, if they're interested to speak to you about their mortgage options and your services?
Yeah, well, I think what we'll do is we'll put, if we put the contacts details, say in the comment section, you can have a look on there, send me an email or fill out the form on the Property Cloud website.
Yeah, fantastic, mate. Okay, I'll do just that. That's pretty much everything. Thank you very much for watching. Thanks, Ben. I really appreciate your time today. I think you've been very invaluable. There's some great advice there and a lot of information that any viewers can sort of take to the market when they're starting their process of buying a property or remortgaging, etc. But thanks very much, and speak to you soon. Take care.